Hey everybody, I'm Kyle Palmer, and I'm here again with Harrison Redolia, and we're going to do a little 2016 market recap. So, are you sure it's spelled correctly? Oh shoot.
I think you had a little typo there.
Okay, thanks Harrison. So let's start with average home prices. You want to talk a little bit about average home prices from January 2016 to January 2017?
Sure. So back in January 2016, the average home price in San Diego was $586,000. Fast forward 12 months, 2017, and we're at about $618,000, which is a difference of $32,000. So as you can see, prices went up pretty significantly in 2016.
Wow. Okay, so a little bit of increase in home prices. Now, interest rates. Okay, so we're going to look at the bond market, mortgage-backed securities. Basically, kind of did this, little pretty steady. This is normal to see this normal volatility here. Then we had a little bit of funky thing here going on, and all of a sudden, so this was about July 4th here. Do you have any idea what date that was or what happened there?
I'll take a wild guess. Does it start with T and end with rum?
It sure does. So right here is this huge drop in mortgage-backed securities, which drives interest rates, unfortunately, up. So you have a decrease in the price for securities, rates go up. Now, what causes this? Well, this right about here is when a lot of people were pulling their money out of the bond market, which would be nice and steady, and they're moving it into the stock market because the stock market took off. So after the election, the stock market was really booming. Hopefully some of you made a lot of money on that. But then what happens to interest rates, they start to go up a little bit. So right now we're trying to catch back up to that curve, but their rates finished off a little bit higher than they did in 2016. So let's look at how those compare. So
as Kyle was mentioning, we started January 2016 with rates at around 3.625%. And those increased to an average of 4.25% in January 2017, which makes for an increase of 0.625%. So when you compound the price increase with the rate increase, the affordability of a house in San Diego just decreased by around $70,000.
Wow.
Over the course of just 12 months. Means your purchasing power decreased by $70,000.
So that seems like a large number. So why is it 70,000? Is it, I mean, housing prices only went up like 32, the rates are a little bit higher. What's the deal?
Because rates affect how much you pay over the course of 15 or 30 years. Okay. So if you're paying more on average, it's going to add up to more every single month for 15, 20, 30 years.
So you're saying, though, if I could normally get pre-approved for a $500,000 home, you're saying that now it's down to $430,000?
That's not right.
Wow. So what does that mean, though? Does that mean like way less people can afford homes now, or like how drastic is it?
Not necessarily. I mean, the homes are still pretty affordable, historically speaking, but it's actually a pretty good time to buy because prices are going to keep going up. They're expected to continue to rise throughout 2017. So if you buy now, you're already making a return on your investment for the course of 1 year.
So there you have it. I mean, without getting into 2017, which we're going to be launching very soon for you, is going to be our predictions for 2017 and see how this plays into what we think is going to happen this year. So, as always, thanks for watching.